Chapter 2 brings up the GST for the first time. So to understand it, let's start with a very basic example. You go to the cafe and purchase a Coke for $3. The cafe will charge you $3.30 with the 30 cents representing 10% of the sale price, which is the GST. So you hand the cafe $3.30 and the cafe gives you a bottle of Coke. Looking at it from the CAS perspective as a business, the $3 of revenue is its to keep. It will increase its owner's equity as it is revenue, but the 30 cents of GST is actually going to be a liability. While they've collected it, it doesn't belong to them. It's actually money that's owed to the government. So when we have a debt or an obligation, that's classified as a liability. How the government designed the GST system to work was rather than the consumer giving the 30 cents directly to the government, which would be impractical, the government actually requires the consumer to give the 30 cents tax to the business, and then after 90 days the business gives the tax to the government. So you can see for a period the business is going to hold on to money in the form of GST that it doesn't actually legally own, and it will be the government's money. So therefore this is going to be a liability. So how it works is we pretend we have a big pot or pool of GST, and each time we collect or charge GST, that will increase. So for example, we have a sale of $1,000. The $1,000 is revenue which belongs to the firm. The $100 is a liability that actually will go to the government, and it's money that's not ours. It's an obligation to pay the government. So we'll have a $100 liability. Assuming a second sale is made, the $2,000 plus GST, well, the $2,000 is revenue that the business gets to keep. The $200, while we've got the cash, it does not belong to the business. It will increase the amount we owe the government, which is now $300. However, the government lets us offset what we owe by taking out what we've already paid in GST. So assuming this month we've paid a rent of $1,000 plus $100 GST, the $1,000 is an expense, and the $100 of GST, we actually get to take that out of what we owe. So if we already owe $300 to the government will let us take out the $100 that we've paid, and we now only owe $200. Then we pay fuel of $500 plus $50 GST. The $500 of fuel is an expense, and the $50 of GST is going to offset what we owe. So looking at the $50, we owe the government $200 based on our previous transactions. Because we've already paid that $50, we can now lower the amount we owe the government to $150. Looking at the accounting equation perspective of these transactions, assuming we had a cash sale of $500 plus GST, we've got $550 of cash. Our liability goes up because the $50 of GST doesn't belong to the firm, and we've made revenue of $500. Looking at the accounting equation, we've got assets going up $550, liabilities up $50, and owner's equity up $500. Assuming that we made a credit sale of $700 plus GST, debtors in this case will be the asset that increases. GST will also increase, and so will capital. So the transactions are identical in their effect, whether it's a cash or credit sale. The main difference will be that it's the asset that increases. With a cash sale, that'll be cash that goes up. With a credit sale, it'll be debtors. Looking at payments of GST, assuming we got charged $200 cash for our internet this month, and we also paid GST, we have $220 less money. We've reduced the amount of GST that we owe the government, and we've got an expense of $200, which lowers owner's equity. So from an accounting equation standpoint, assets down $220, liabilities down $20, owner's equity down $200. Assuming another expense, this time insurance, $400 plus GST. Let's assume in this case it was paid or hasn't been paid and is charged on credit. So the first difference is I've now got a creditor of $440. I owe them for the insurance and the GST. I've decreased my GST liability by $40, and the $400 of insurance is an expense which lowers owner's equity. So you can see the effect on GST and capital is exactly the same for a different amount, but the same direction. What's different in this case is we've got liabilities going up $400 and owner's equity down $400, and it's in the top example it's cash that decreases, whereas in the bottom example it's creditors that will go up. Just to summarize how GST works, when we collect it or charge it from our customers or to our customers, that increases the amount we owe the government, and our GST pool or liability will rise. However, we get to offset by taking out everything we've paid in GST or been charged by creditors. So in this case, it reduces the amount of GST we owe and therefore reduces our liability.